In a bid to mitigate lifestyle effects of Covid-19 post-retrenchment, majority of Kenyans and local businesses in the last 3 months have resorted to taking loans from both digital and physical lenders alike.
The demand for loans is relatively high, but it is being pushed by the need to fill in the gap, because most of the people have the same or lower incomes, but the demand and cost of the demand for expenses or cost of living has gone up.
According to Jijenge Micro Lending Firm Chief Executive Officer Peter Macharia, digital lending in the country is highly unregulated, thus paving way for easy cloning of their platforms by unscrupulous dealers, as well as unregulated high interest rates.
That impulse buying, unplanned holidays, unplanned fun and festive expenses will definitely come in, and the demand will be there, will be very high. However, on our part as Jijenge Credit, we have enhanced our credit analysis system so that we avoid lending for partying. We avoid giving money to buy a booze.
On the back of the end-year festivities warm-up, Macharia says they expect a rise in loan and credit borrowing. He, however, says they are focusing more on business lending rather than lending for consumption, owing to the dent brought about by non-performing loans as a result of the moratorium approved by the president in June this year.
If you lend out money easily, you see, lending through an app is that you're borrowing money from the comfort of your house, or from the comfort of your sinatabu stool in a certain pub. That kind of lending is very tricky because it is unplanned for. It is money that you've not thought through how you're going to repay it. And therefore the probability of it turning bad or it failing to be paid is almost 100%.
The Financial Access Survey 2019 indicates that unregulated digital lending increased from 0.6% in the past year to 8.3% in 2020. The Senate Standing Committee, led by Senator Mutula Kilonzo Jr., has since called on Central Bank Governor Patrick Njoroge to fast-track the amendment of the CBK Amendment Bill 2020 that seeks to curb the constant rising of digital lending rates that have left many borrowers in debt traps.
Which was a good way, because you see, most of those borrowers, they borrow it on the spur of a moment. So it's not their wish also to be listed, because they've not calculated the consequences of borrowing, and then they are listed.
Meanwhile, Macharia lauded the Central Bank of Kenya for banning unregulated digital and credit lenders from submitting credit information of their borrowers to the Credit Reference Bureau. Solitei reporting for K24 Business.